Fed cutting interest rates by 50 basis points. What impact will that have on the deal-making landscape? Well, joining us now is Guggenheim Securities Senior Managing Director Eric Mandl. He advises companies in the tech, media, and telecom sectors. Eric, it's great to have you back on. And that's exactly where I want to start, because I feel like all year long we've been saying, pent-up demand, M&A, the floodgates are going to open. And yes, it did a little bit. And we have seen some strategics specifically start to dip their toes in and make acquisitions. But we haven't seen the wave that everybody's expecting. Does this now, with the Fed cutting, change things?
Yeah, so first off, let me just say, Morgan, John, thank you so much for having me on. Always great to be with you guys. I think you really hit the nail on the head. So if we take a big step back, this last year has been very volatile, a lot of ups and downs. And I don't want to jinx it, but it does feel like this is the first time where good news actually means good news. And the reason that's so important is there has been a lot of overhang in the way the market trades, obviously in a broad way, but in specifically tech, which is where we spend a lot of time, of what is actually going to happen with interest rates. And as extreme as inflation has been, no matter which side you're on that trade, it is very healthy for three reasons to see a cut. Number one, it's confidence building. You need people that are going to be leaning in, using financing, and also using the market to their advantage to believe that things are moving in the right direction. Secondly, there's just a fair amount of self-imposed pressure, especially by the two largest groups that do the M&A in tech, and that's strategics and private equity firms. Private equity, no doubt, has been more affected by higher interest rates, and I think this is now moving in the direction that gives them that comfort. But then thirdly, which I'm happy to say we haven't heard anybody talk about yet, it's amazing it's only been 24 hours since the cut, is when interest rates go down, it actually allows companies, especially in tech and especially in software, to be able to take advantage of lowering their interest rate costs, because many of these are levered, whether they're former sponsor-owned assets or they're public assets, and be able to increase their free cash flow without ever actually lowering their top growth rate. And I know that both of you have heard me talk about this rule of 40 concept. Rule of 40 is very sensitive. You know, years ago, it was all about growth. Then it was all about margin.
Yeah.
Lowering of the interest rates is definitely going to help, at least from my perspective, what we're seeing so far.
Okay, so in light of that, where do you expect to see some of this deal-making bubble up and become more active? I mean, it does seem like a lot of it so far has been driven either by AI and or cybersecurity.
Yeah, great point, Morgan. So, I'd say two big factors to unpack. Let's take AI first. AI, without a doubt, is the most central thing that we hear from investors, from companies, from boardrooms, and people looking to do M&A. I think the flip side on it, though, is a lot of the AI that we're most drawn to in the press really is very early stage. It is a component of the technology compendium that does not really generate very much free cash flow at all. So I think we're excited about deal making, and I can tell you, just obviously anecdotal, at Guggenheim, I don't think we have ever been this busy with the velocity of conversations that we've been since 2021. That's how long it has been for that type of velocity. It's in the boardroom and it's in the public space. And a lot of that is driven by private equity. So to answer your question, Morgan, we have this very interesting relationship where public companies are trading at a premium for sure. But remember, your average next-gen software company in 2021 is trading at 13 times forward revenue. Right now, it's trading at 7 times forward revenue. So it's really come down. And I think there's a story that can be told to private equity as to why it might be better to be a private company rather than a public company. I can tell you the vast majority of our energy as advisors is spent on that exact topic right now.